Justin coming to you from Austin, Texas, my hometown. You're seeing me here because I am in town for the summer. Some really great stuff. Basically, last week of the HFO trading team was kind of eventful, not in a good way though. Actually, Roger, if you had read, was struck down with some sickness and had to go to the hospital for a while, so that was really holding us up, and that is why we did not place any new trades last week. We do have a couple open positions though. Be looking for us to come in strong next week. We're going to try to make up for that time that we lost and try to find some great trades out there for y'all. Okay guys, the HFO watch list for this week is going to be, we got about 6 stocks on here right now with special emphasis on 2 of them. It's going to be GMCR, PCLN, SCTY, TSLA, and then the 2 that we're really focusing on for some trades in the next coming week is GDX, which is going to be a gold and silver index, and YUM. And let's just look at those 2 that we're putting emphasis on. First of all is YUM. Roger was looking at the Bollinger Bands, and he was looking at some volatility. I can see right off the bat that the Bollinger Bands are much closer than usual, as you can see from these. Usually they stay farther apart, and once they start converging like this, it's been consolidating for a while, but you know there's going to be a breakout sometime when those Bollinger Bands get so close. The ADX is pretty low, so it's definitely ranging and not trending, but that's okay. Not all of the indicators always have to match up. And let's see, the MACD is a little lower than usual, but it definitely has room to rise. And the stochastics is the final indicator that I would say that the stock is bullish. Because this you're always looking for this cross down here of the black line crossing over the red, and I think we might be looking at some calls near term on this. Next is going to be the ADX, which is the gold and silver index, and it looks as though the Bollinger Bands popped right about here, right about there, and they have been it's been trending upwards. I don't think it's hit its top looking at this MACD. I definitely think there's still room for it to rise. Obviously, in the past, it is back in the very beginning of 2014, it definitely rose a lot higher than that. So we're definitely looking at room, but also the stochastics, because it's at the top, which would usually indicate bullish, but it's looking like this black line is about to cross over the red line again, which indicate another bearish move. So it might hang up here like it did in these past few months, and sometimes it can hang up here for almost a month, it looks like right there. This one's sending a little bit more mixed signals, but in the near term, I would say how far these Bollinger Bands are apart. They've popped, and now they're very far apart. Usually it sticks with the trend for a while, so I would also be looking at some calls on this in the near term. So that is your watch list for the week. Okay guys, this week's informational segment is going to be on Straddles and Strangles, and yes, it is true that I have done Straddles and Strangles before. I did it in a previous strategy of the week, and I will link the video, but we are focusing on Straddles and Strangles right now because the month of May is the start of the summer, and in the summer we can start to see a little bit less volume. Some of the institutional money not kind of taking profit, stuff like that. So you don't see as much volume in the market. So that can lead to less volatility and harder to find trades, basically. That's what Straddles and Strangles are beautiful for, because you don't necessarily have to be exactly sure where they're going. All Straddles and Strangles feed off of is volatility, and they are consistent returns. Are they big returns? Are you going to get the high flyer percentages of 50 to 200%? You're not going to get the ones that are doubling on these, but it's for steady, consistent returns somewhere. But maybe we can say around 3 to maybe 10, even 10%, 20% sometimes, but basically the safe play. It's an unpredictable market. One of the best strategies to use is non-directional. Directional being you buy a put if you think it's going to go down, you buy a call if you think it's going to rally up, bullish. Non-directional means, hell, we don't know where the stock's going. We know there's some bad earnings. We know that it's very volatile right now. And we know it's going to move some way, but we have no idea which way it's going to move. That's non-directional because you don't have to know where it's going. That way you can make money as you're hedging your trade, and you should be able to take profits. Straddles are a pair of options that are a call and a put with the same expiration date at the same strike price. And that's going to be a little profit graph of straddles. Strangles are a pair of options with the same expiration but different strike prices. As you can see, the strangles are separated. The straddles are together because they're at the same strike price. These can be used in non-directional trades, as it does not matter which direction the stock moves, as one of the sides will move into the money. Basically simplifying it, you're buying a put and a call, so you're going to make money on one side. And these strategies are betting that you're going to make more. You tend to make more money on the side that it does end up moving in the money to, it does end up moving towards, and then you subtract the loss from the other side, and that is your small consistent return. The other side might swing in your favor and move in the money as well, but that would be an added bonus. As long as one of the straddle or strangle legs moves to cover your loss on the other side, you will do well in your trading. Straddles cost more but have a guarantee of profit. With the strangle, both the call and the put can expire, worthless in a worst case scenario, which we always want to stay away from. You don't want to get exercised. As a straddles, calls and puts have the same strike price, both expiring worthless is impossible. Straddles work on a smaller moves in price, so these aren't for the crazy volatility. These are basically the safe bet on milking money out of a consolidating market. It might move a little bit, but you don't think it's going to make any huge jumps. You don't think it's going to be trending up and down on the average true range, stuff like that. It's just making small moves. If a strangle is used on a smaller move, there's a greater chance of both legs expiring worthless. So you have to be sure that you're tailoring your trading strategy with how the market and how the market, the sector, and the stock are going. So you got to look at all three of those before you're going to be doing them, because they're very different strategies and they're used for very different scenarios. That is your information segment of the week. Okay guys, that's going to be it for this week on the weekly recap of the trading week ending on May 9th, 2014. As always, we wish you luck out there trading, and hopefully we can find some winning trades, as summer can sometimes slow down the market a little bit, but we're still going to be trying to find those winners for you, those high flyer winners. So thanks for watching, and I'll see you next week.